This is a crash course on personal income taxes for young Aussies. And I want to start out by saying that taxes aren't necessarily a bad thing. First of all, if you're paying taxes, it means that you're making money. If you're paying a lot of taxes, you're making a lot of money. It's a good problem to have. But more importantly, you are who you are today in no small part thanks to the infrastructure and services that are paid for with your taxpayer dollars and the money of taxpayers that have come before you. The school that you went to, the roads that you drive on, the hospital that you visit, and the national parks that you camp at, the nurses and teachers and fireys and police officers, all of these things are paid for with taxpayer money. And they're a big part of what makes Australia such a safe and beautiful and desirable place to live that consistently ranks in the top 10 places in the world to live above all of our most culturally similar rivals, the US, the UK, and Canada. And you should be happy to contribute a little bit of your income towards keeping Australia such an amazing place to live, not only for yourself, but for future generations to come. And with that said, let's jump into the taxes themselves. Australia has what's called a progressive income tax system. And all that means is that you pay a slightly higher rate of tax as you earn more money. Now, these are broken down into what's called tax brackets. And these do change from time to time, but this is what they look like for the 25-26 financial year. I want to explain these by going over one of the most common misconceptions that I hear about income taxes in Australia, which is that if you're on the borderline of two of these brackets, it's best to not earn any more money because if you do, you'll move up to a higher tax bracket, pay more taxes, and end up with less money in your pocket at the end of the day. And that is just 100% not true. And you should always jump on any opportunity to increase your salary. The easiest way to demonstrate this is with this bottom tax bracket, which is called the tax-free threshold. If you earn $18,200 or less this year, you pay zero income taxes on that money. Now, our misinformed friend says, well, if I start to earn $19,200, I'll move up to this higher tax bracket and I'll have to start paying 16% tax. If they take 16% tax out of my $19,200, I'll only have about $16,000 left in the bank and I'll be worse off than I was before. And that would suck, except that's absolutely not how it works. You only pay the higher rate of tax on the income that falls into that bracket. In this example, you still pay zero taxes on the first $18,200 that you earn. You only pay 16% on the extra $1,000 that falls into the higher tax bracket. 16% of $1,000 is $160, so you'll pay $160 in taxes and you'll get another $840 in your pocket, bringing your total after-tax income for the year up to $19,040, which is of course much better than the $18,200 that you were earning before. It works exactly the same for all of the other tax brackets as well. If you're currently earning $45,000 and you get a raise to $50,000, you only pay the new 30% rate on the extra $5,000 that falls into that bracket. The bottom line is that you should always try to earn more. Take that raise, get that bonus. There is never a situation where earning more income will result in you having less money in your bank account at the end of the year as a result of the tax brackets. So what counts as income? For most people, your main source of income is going to be the wages from your job, but there are a few other things that you have to keep in mind. If you get any interest on the savings in your bank account, which hopefully you do now because you watched the first crash course video, those interest payments do count as income and you have to pay taxes on them. You also have to pay tax on any dividends that you receive, which are payouts that you may or may not get if you own some stocks. You also need to pay taxes on any capital gains that you make. A capital gain is when you sell something for more than what you bought it for, and this usually is referring to stocks or property. If you sell a stock for more than what you paid for it, you have to pay income taxes on the profit that you made. Lastly, you also need to report any income that you make from a second job or from a side hustle. If you're making money on YouTube or TikTok or you're selling cookies at the Sunday market, that money does count as income and you do need to pay some taxes on it. And the way that we sort all of this out is with your tax return. Now, I'm going to make another video that goes in depth on doing your own tax return, but for now, I just want to cover the basics. Each year that you earn money, you need to submit a tax return. And that's not the calendar year. The financial year runs from the 1st of July till the 30th of June in the following year. So that is the period of time that you'll be submitting information about. What a tax return boils down to is entering information about all of the money that you've made, entering information about any deductions that you have, and then entering how much tax you've already paid, which has been taken out of your wages by your employer. The tax tool will then calculate your total taxable income for the year, the amount of tax that you owe on that, and then compare it with the amount of tax that you've already paid. Most of the time, you will have already paid more tax than what you actually owe, and so you'll get some of that money back, and that's why we call it a tax return. In some circumstances, you might not have paid enough taxes and you will get a bill, but that's pretty unusual for most people. Now, I quickly want to talk about deductions. The best way to think of a deduction is money that you had to spend in order to make your income. And unfortunately, a lot of people don't go and find out what they can deduct from their work. And you're potentially missing out on hundreds or maybe even thousands of dollars in savings on your tax return each year. So I want to quickly run through the most common ones for an average worker. First is uniforms. If you're required to wear a uniform for your job, you can deduct not only the cost of that uniform if it's not supplied by your employer, but also the cost to wash or dry clean it. Education materials is a really underutilized one. If you spend any money on books or training or a course that is for the benefit of your work, you can fully deduct the cost of all of those from your income taxes each year. Vehicle expenses is another common one. Now, this doesn't mean the cost of driving to and from work each day. But if you are required to drive your own car as part of your job, for example, you're a real estate agent and you need to go from the office to a property and back, you can deduct the tolls, the fuel, and some wear and tear from your car for the period of time that you are using it for work purposes. You can also deduct PPE and relevant tools. If you need to go into a factory or onto a job site as part of your role and have to provide your own protective glasses or high vis, that can be deducted. If you're an engineer and you need a scientific calculator for your job, you can deduct that as well. And the last common one is working from home expenses. If you work from home for some or all of your job, you can deduct some of the costs of your home workspace from your income taxes. The ATO has really good detailed guides on their website. It covers all different types of deductions for all sorts of jobs. So before you go and do your next tax return, definitely check my video out on this and go and check out the ATO website as well. Lastly, I want to answer a pretty common question, which is, do I need to hire an accountant or a tax professional to file my tax return? Honestly, if you're a pretty average person, you've got a job, you've got some savings, maybe you've got some stocks, absolutely not. The ATO's website and the My Tax tool is really good now. And thanks to some improvements with the technology, often a lot of the information on your tax return is automatically filled in. For anything that isn't, your bank and your employer and your stockbroker will provide you with forms at the end of the financial year that will tell you basically what to put into each of the boxes on your tax return. I think it's really good to do your tax return yourself to understand how it works and also how easy it is. And of course, to save on those fees that you'll get charged if you pay someone else to do it for you. The situations where you probably should hire an accountant is if you have an investment property or if you're running your own business as a sole trader. In those scenarios, it's good to hire an accountant at least for your first year to make sure that you're doing everything correctly and to make sure that you're taking advantage of all of the specific deductions that are available in those situations. So that's it. This isn't a fully comprehensive explanation, but I hope that it gives you a clearer understanding of your taxes, deductions, and your tax return. Definitely go and check out the rest of the crash course because I want you to have as equally as good of an understanding of superannuation as well as the basics of investing and index funds. There's a bunch of other videos on the channel as well that go into more depth on these topics and more. So if you're interested, subscribe and go and check some of those out.